Financial freedom through passive investment in real estate. We were just recently down in Houston this past weekend. We'll be with my esteemed co-hosts here, Doctors Noel Liu, and as well as serial entrepreneur, Mr. 10X Tom Varghese. And we're very excited to talk about this because we were literally in Houston this past weekend. I had checked out on some asset management calls on a property that we invested in on Saturday. And I also checked in on a property that checking on the renovations and how things were going. And in the afternoon on Saturday, we went and checked out a property that we are actually in the process of acquiring. The very next day, I had the pleasure of meeting Noel and Tom for the first time in real life. We've met virtually for hours and tens of hours, maybe even 100 hours at this point. And we finally got to we actually met, and and it was really good to meet these guys. And we also we announced that we had a meetup in Houston, right? And we had 9 people from this Facebook group show up to the meeting, 9 doctors. And that was totally awesome. I mean, we met Ramsey. I don't even remember the other guy's name, but there were several guys, a couple of guys who were multifamily real estate investors. And several of them were just trying to get started in real estate investing, so that was great to see. So the subject matter of this particular visit was a 16-unit property that Tom actually pitched to Grant Cardone on his TV show. So you want to talk a little bit about the property? I think today, why don't we talk a little bit? We'll keep it brief today. We'll talk about that 16-unit property, how much you bought it for, how much you think renovations, how much you think you can make on this property. We'll go through the numbers a little bit on a high level. And then we'll talk a little bit about the meetup itself. And then we have excited about what's coming next week. We're going to tell you about a very special guest that will save you an enormous amount of money on taxes and start the snowball effect of perpetuating your wealth through retirement. But Tom, tell us a little bit more about the 16-unit property that we visited this past Sunday in Houston.
Yeah, actually, man, it was a great time to see everybody and do our first meetup. So it was wonderful. So now and we were at the location. Noel and we were at the location. Noel did a walkthrough and live video from there. So now here's the thing about this property was on the market sometime during February of this year. And we saw it on the market, and we negotiated the price, finally agreed on the price, and we put in an offer. And it's a 16-unit property. What we looked at was what the area was like. The area, as anybody who came there saw, that it's actually in the Montrose area in Houston, which is actually one of the upcoming. It's Trader Joe's walking distance, Starbucks right behind this, all the restaurants close by, Whole Foods 5 minutes from there. So the location is awesome, right? So we saw that the location was great. Property is maybe B minus kind of thing, but there's a lot of people who would want to live in that area, and the houses around there are going for 800 plus. So we knew it was a winner in terms of the location, the walk score, all that stuff. So that's what really, to be honest with you, what attracted us to this deal.
What was the purchase price, if you don't mind?
The purchase price was 1.6 million. So 16 units, $1.6 million.
$100,000 a unit, $100,000 a door.
Yep.
All right. Now, what type of property? When you said this was a B property, right, versus an A property, was this a value add property? Was there meat on the bones that you could drive rents through renovations, or was it already renovated? Or
exactly. So now whenever we buy a property, we want to buy a property where we can jack up the rents. Not, let me use a better term, where we can increase the rent, based on the market conditions, so we can appreciate the value of the property. And when we exit the property, everybody, the investors and us, we can make money, right? So that's really the criteria. We looked at it, irreplaceable area, B asset, B minus, which is actually good, which means we can go in and none of the units, about 2 units were renovated, which was getting about $150 more than other units. So we knew right away that an opportunity. If we renovate the other units, guess what? We're going to get $150 just by renovating. And here's the
Mhm.
deal: just by not doing anything, we noticed that it was like below market rents. With rents were about $800 average, we knew that was going about 900 to $950. So we are renewing it right now already at that price. So we
Nice.
saw that opportunity, and that, guess what? In their 16 unit, if you're able to increase the rent by $200, and about you're looking at about close to 700, 800, $1,000 in increased evaluation for the property. So that we saw that there was opportunity there. Besides two units, none of them are rehabbed, which means we can go in, put some nice countertops, replace the appliances, put new paints, and guess what? The rent just went up by 200, $220. So that's the deal with that property. That's
$220 in a month per month.
yeah,
Right. So that's another 22, 26, close to 26.5, 26.6 a year,
yeah.
$26,000 a year of
Mhm.
income. That's just from one unit.
1 unit and
Woo.
times 16.
Times 16
Yeah.
divided by cap rate.
Cap rate of five or 5.5 is what we got it at. So maybe we should do the math here, so people can
Let's do
understand.
it real quick.
Okay.
Yeah, let's
One,
do that real quick. You
yeah,
got
we'll
it.
be
150
conservative.
bucks.
Let's do 150 times
150.
16
Mm-hmm.
times 12. So this is our additional NOI, right?
So that's for
Yeah.
one unit. If we raise the rent by $220, right? That's the
Times-
income times
No, I
12
did
months.
$150.
No, he did 150.
150. Okay.
Just to
So
be
if we
conservative.
raise the rents in one, so now we have a 16 unit property. We know that we have the ability to raise rents by $150 just by renovating unit, because we know that it's right now it's getting under market rent because it's
Mhm.
in a rough state, right? So
Yup.
now Tom, you said it's about 700 a month, right? That you're getting on average here.
800
800,
average. Yeah.
and you're
Yeah,
expecting
so-
to drive rents by another $150 to 950, right?
Yup.
So $150
Right.
premium by renovating the units. Now 150 times 16 units.
16.
Yeah,
16.
times 16 units.
That's per month.
So per month we get extra
Times 12.
$2,400 of extra income times 12, $28,800 of extra income.
Now that's
say
the
we have-
extra income, right? So
The
the
gross
extra
income.
income by simply increasing the rent, not the total income. Simply by increasing the rent, we are adding the value. Now let's talk about the math on how the value of the property goes up as a
Mhm.
result of this. So 2,800 to 28,000, 28,800, right? Divided by the cap rate. Let's say about point zero, about 5 cap. In that area, it's about 5 cap. So if you do a 5 cap, what are we looking at? So the
Divide by
value,
5%. You drive the
Yep.
value by $576,000.
see that?
$576,000, right?
So the 1.6 million dollar property went up by an additional $576,000, which is about 2.2 million bucks.
Close to 2.2 on the exit, 2.2 million on
And
the exit. So
we did a conservative 150.
And that's $150. That's assuming that rents don't continue to go up. This is with rents stay flat at where it's at today. But we know that in Houston, the Yardi and the other prognosticators in the commercial real estate arena have said that Houston in general will see at least a 6% rent increase, which is a slowdown from last year where rents went up 13% in Houston. So when the rest of the country's slowing down, Houston is also slowing down, but it's slowing down to from the teens in rent growth to high single digits. So even a 6% rent growth is still a healthy margin of rent growth that's forecasted even during a recessionary time. And the reason for that is that Houston is just a booming place for jobs. There's tons of jobs. There's tons of people moving there, and that's driving the rents. So what these calculations that Noel just did here, this doesn't take into account this potential that there's going to be even more rent increases. If we don't even care, we're like, listen, if the economy just stays stagnant and we just get to what it is, what market is right now, we're still going to generate at least close to $600,000 of value. That's called forced depreciation. That you can generate it's completely operator dependent. If you just conduct the business plan, renovate these units, put the higher paying tenants into the units, you're going to drive the value. Doesn't matter if the market's going up or down. Now, if you have a position where people are moving and competing for the scarce resource, then you get market appreciation. So there's forced appreciation, and then you have market appreciation. So market appreciation is just a cherry on top in value add. Whereas in Class A or luxury, you depend on market appreciation, which may or may not be there in a luxury segment during a recession. Yeah. Class A people become Class B if they can't afford it, right? Class B become Class C. Class C can't go anywhere. So B and C is a great place to be positioned. So during a recession, during recessions, during downtimes, that may or may not happen. So continue on, Tom. Now, did you do this was this done in a syndication structure? Did you have partners? Now the total property was 1.6 million. What was the debt look like? How much did we borrow?
The debt was the debt was 75%, and we came up with the 25%, and we have about 10 to 12 investors, I think, on this property, and it was a joint venture deal that we did. So we didn't want to go and do the syndication because it's a smaller deal.
Sure.
We did a joint venture. Which
JVs were great. I mean, there's a lot of people that use JVs even for large deals. I mean, usually land and development and stuff. But JVs were great. So now you said about 10 investors total.
I think it's about 12, something around 12. Yeah, between under 15 though. So excellent. Somewhere around there, yeah.
And guys, I'm going to share this screen real quick so that
Yeah, sure.
So people can watch and see what's going on.
This is the property that we actually looked at in Houston. One of the properties we looked at in
Houston. Right. And this is the property that I pitched. I was on the show, the Real Estate King show.
Real Estate King.
I was presenting this to Grant Cardone. So so we were going to sell it to him, and he was going to fund the deal. So he really loved it. In terms of the location, he said, "Man, this location is sick. It's really hard to please Grant Cardone with the location."
Which submarket is this?
This is Montrose area.
Montrose, okay.
Hey, can you guys see?
Yeah.
Yep.
Okay. So this is the 2006 Sol Ross, Houston, Texas.
Yeah.
Hey, Tom, what I'll do is I'm just going to go over the slide real quick. So and you can continue talking, and then people know, where this is.
Keep going. Yeah.
Yeah. Just go to the kind of the highlights here, because we're kind of already, getting to the time.
Yeah. So let's take a look at this. Tom, you want to just explain this real quick?
Can't really see that one, Noel.
Can't really see that. Yeah. Can you?
Really?
Is there a way to blow it
You got
up?
to maximize on your screen.
Yeah, I maximized it now, so I can see it now. So purchase price 1.675. The cap rate is actually 5.5%. I think when we went in at 6%. So I think the exit is 5.5. Capital raise is exactly 75% of that. The rents were about roughly $175 to $200 below market, and it was 100% occupied. So in terms of occupancy, we know that place is hot. Like I said, is there echo?
Yeah, you're echoing.
Oh, I didn't hear any echo.
Yeah. So Why is the echo? I don't think it's from me, but anyway, it is from. It is in a great area, like you can see. See that area? This is super important, guys. Whenever you buy a property, you want to buy it in a top location, okay? Even if it's a C property, no big deal. I mean, there are exceptions to this, but for the most part, you want to make sure the location because the location is irreplaceable. See that Rice University, 5 minutes from there, Lakewood Church, Bed Bath and Beyond, River Oaks. The top location in Houston is called River Oaks. It's about 7 minutes drive from there. I mean that's where all the billionaires live, 25 million dollar homes and stuff like that. So that's about 7 minutes. So that location is hot, which means people always will want to live there. It's walking distance to everything. What is next? Is there a walk score somewhere in there? It should say, yeah, the walk score is 95 out of 100, which is non-existent in Houston and Texas. I mean, it's pretty hard to find anything about like a good walk score unless you're in the right place, right? Whole Foods, yep. If you see Whole Foods in any property and that's close by walking distance, you can pretty much buy it eyes closed because they will never put Whole Foods in a bad location. Bike score, all that good stuff. What is next? 5-year projected metrics. So 5-year IRRs, we projected that it'll be returning about 21% IRR, which is basically the average annual return when you add up all the cash flow and all that stuff. Now, what is the business plan? The current average rent is about $800, and we want to increase it by about 150 to $200. So we put the average at 175. And when a unit goes vacant, we want to rehab it. But here's something that happened. We saw after we bought this, we could increase the rents without having to rehab the property. So we didn't even rehab some of the units. It was easily going for 175 over what it was renting for. So some of the units, without even rehabbing, we have already rented it out. However, we are planning on rehabbing some units because I think we can increase more rent over there.
And some of them were because they were occupying, they were just renewing the rents and you
Yeah,
could not rehab it, right?
yeah, you couldn't. They were willing to stay there even when we said, "Hey, man, your rent's going up." They said, "Sure, I don't like it, but I have no." I mean, you can tell they didn't say that, but they're not. but they accepted it and they stuck
Hmm.
around. So that's good. So potential sale in 5 years at we are projecting we can get out at 2.4 million bucks, which
Hmm.
means it's about $800,000 in profit, plus all the cash flow that comes with that. Um,
And Tom, just briefly, like in a quick sentence, if you were to refi it in 3 years, what happens to the investors' portion? They get most of the investment back from the slide.
yeah, absolutely. So that's something that a lot of people don't understand, right? So now there is $2.4 million is what we are projecting that this property will be valued at in 5 years. Okay, let's say in 3 years it'll be 2.2 million bucks. It'll be valued at 2.2 million bucks. So we go to the bank and say the bank says, okay, guys, yeah, the property is 100% occupied. We are valuing it at 2 million bucks. All right, so that's still 400,000 more than what we
Mm.
went in, right? So that 400,000 is going to come into us when we refi. They're going to value it on 2 million, and there's that 400,000 appreciation we got. We take that 400,000, send it back to all our investors, and almost everybody's going to get everything that they put to buy this property. That's the
Awesome.
game plan. That's how you make infinite wealth. That's how you keep on
Mm.
making money. At that point, you got all your money back and you're getting money every month. As long as the property is there, as long as it's not sold, you will get money every month for the rest of however long the property is
Awesome.
is is,
Yeah.
is not sold.
All right,
So
let's kind of
that's
start trying
infinite.
to land the plane a little bit here too,
Yeah, let's
Tom.
land the plane.
Yeah,
So that's the deal.
yeah. Is
Yeah.
that you got a lot more to go on this? Just let me.
No, no, no. We're almost there. These are mainly
Okay.
pictures. So let's just
Sure,
let's
Okay,
just
cool.
wrap it
right.
up here. Yeah. So
What is the last slide? Okay. Yeah,
okay.
these are
So
some
the
of the
last slide I
pictures we
want
had.
you to go over, Tom, is right here.
So here's the thing, guys. This is anybody who put in 100,000. This is what we projected. Year one, they get that 6.4%. That's 6,400. Year two, with the appreciation, the rehabbing, all that stuff, the money goes up. Year three, it goes up by 10,000. And finally, you see that year five, there's a big chunk of money that's coming in because of year refinance. And then at the end of the day, anybody who put in 100,000, they're going to get 42 something is what we're projecting.
So basically 2.4x.
Yep.
So this
Nice.
is just to recap everything that Tom just said, and
Yeah.
and that's pretty much it. So guys, just to give you a heads up, this deal is not active. It's a closed deal.
Yeah, just representative, right? It was just representative.
Yeah, this is just strictly just for educational purposes, just basically to see, like, you know, what an investor deck looks like in a simple form.
What a real deal looks like. Yeah.
Yeah.
Right. So I think that was tremendous value. I mean, I know that the guys that showed up to the meetup, let's talk a little bit about that. I mean, the meetup was pretty good. I mean, we had a good group of guys, good group of people that were interested in investing in real estate. We had all different levels there. We had guys that were very adept real estate investors, very experienced. One guy had over 50 units. I forget his name. Very nice guy. I'm not great with name. I didn't even get people's names. A lot of them.
Was he the one sitting right next to you?
I think no. He was sitting across from me. He had his son there.
Okay. I think I know. Yeah. I forgot his name too.
Yeah, the guy next to me was also Ramsey. He was cool. Cool guy. He's from the Kingdom of Jordan. He's a dentist out there in near the Houston area, right? I forget the name of the neighborhood, but let's kind of start wrapping it up. So next week we have our guest, and this guest is not just any guest, but he is someone that can help us use retirement funds through a thing called a self-directed IRA. Most of us just dump our money and what we're told by financial advisors into 401k plans, SEP IRAs, things like that, which are all completely market dependent. And the only thing you can really invest in is stocks or anything public markets. But now there's a different type of retirement vehicle, which is equivalent, called a self-directed IRA, which now allows you to direct where that investment goes. And there's options beyond the stock market. And one of those options happens to be investing in real estate through syndications, which we're all very, very much big fans of. And so can you tell us a little bit about this guest that's going to be
Noel, did you want to explain about that guest and what we're going to talk about next week?
Yeah.
Oh yeah, absolutely. So this guest is Ramez, and he is from the IRA Club, and basically it was Tom's contact. And great guy. Lots of info, lots of nuggets we're going to drop. So how do you take your earned income, you put it in an IRA vehicle, and how do you take that, you self-direct it, and then you go to one of these vehicles where we are going to be, you can do investments, you can do syndication, you can do loan money. I mean, anything like, in terms of passiveness. So this guy coming in, he is awesome with a wealth of knowledge. He's going to share his info, and we are really, really excited to get this guy here. And it's going to be like a Christmas special, right, Tom?
Yeah.
It's a season to give.
Yeah,
season to give, man. So season to give. So any of you guys watching, if you are really interested, tune in next week, this time, same time. We're going to get Ramez in, and we are going to be diving deep down in IRA and all that good stuff. He'll be dropping in a lot of nuggets.
Very well, very good. So make sure you're there next week for sure. You don't want to miss that, especially if you want to know how you can get your retirement funds to actually grow instead of sitting in a 401k plan, which probably, if you looked at it from what you're 10 years ago, December 13th, 2012, and compared it to December 13th, 2022, I don't think that you would see too much difference. So, let's get involved with something that we can grow. We can make our families benefit from investing in real estate. This is what the wealthiest people in this country invest heavily in multifamily real estate. So the wealthy, I'll tell you what the wealthiest families in America do not invest in, and that's 401k plans. So make sure you're here next week.
And let your family and friends know, because at the meetup too, people brought their friends and I think their relatives too. So if they're interested in this, make sure they tune into this one.
Yeah, this is a good one for any.
do a
I mean, this
watch
is not
party.
just for doctors and dentists. This is for anyone with retirement funds that want to see it grow. This is going to be beneficial. So yeah, and invite. All right. So I think that's it for tonight. I would like to say good night from the passive dentists, passive doctors, real estate investing group. And we'll see you next week.
Take care, guys.
Take care, guys.
Take care.
Bye.